in this video. The crypto market still reacts very weakly to the rally in the American market. Bitcoin option prices remain incredibly cheap. How do you increase your risk without going bust? And as usual, an analysis of the weekly options strategy. Hello friends, this is the Optionomics channel, and I'm your host, Roman Besedovsky. And today, as usual, we'll take a look at what's happening with Bitcoin options and what earning opportunities are available. Let's first review the previous trade. In fact, there was almost nothing interesting that happened there. That is, the Bitcoin market basically stayed in the same place. It was a pretty narrow week. And so basically there wasn't even the slightest opportunity to lock in profits or do anything with the Strangle I bought. As a result, I slightly increased my risk. So as of last week, I had bought 3.2 of the 82 calls and 3.2 of the 73 pots. In total, I spent $1,540 on them, and accordingly, these options expired worthless, so I took a loss on this trade. So here's what's happening right now. I've been having quite a long losing streak starting from March 1st. So since March 1st, my option purchases haven't worked out for about 2 months and 1 week now. And naturally, at times like these, you start experiencing all sorts of emotions. So basically, even though I'm telling you this in a fairly calm tone, in reality, like any trader, I start to get nervous in the moment. I start thinking, what if, I never get that profitable trade again? What if, for example, I end up losing a big chunk of my deposit and so on? So what should you do about this? The best thing that helps is analyzing past statistics to understand that this kind of thing actually happens from time to time. I mean, stretches of weeks when there's no movement, and sooner or later, that movement does eventually happen. In other words, it's almost unheard of for the market to just stop moving altogether. And later, when we discuss the forecast, strategy selection, position analysis, and position sizing, I'll show you why I'm not too worried, even though we're already in such a long streak. So let's move on and get to the Bitcoin forecast. So what am I thinking right now? First of all, let's zoom in a bit on the 4-hour chart. And let's also open the altcoins since we're trading altcoins and take a look. Right now, Bitcoin is pressing up against the 80 mark and just can't break through it. It often happens that before round numbers, the market consolidates. And right now there are two things I'm paying attention to. First, if we look at the American indices, which used to move together with Bitcoin, for example, the NASDAQ, you can see on the NASDAQ chart, pay attention to what kind of rally has happened since March of 26. So starting from the end of March, there was a low at 22,800, and now NASDAQ has shot up to 27,600. For the American market to gain more than 20% in 5 weeks is really impressive. And even on the chart, you can see that the movement is strong. At the same time, Bitcoin has done the same thing if we look at these past 5 weeks. Yes, it has also gone up, but notice that it's still very far from its all-time high here. So compared to the American indices, Bitcoin looks very weak right now. And if we also take a look, for example, at the previous Bitcoin cycle, if we look at the NASDAQ, last time when Bitcoin was falling, which was in 2021, everything was moving pretty much in sync back then. So in November 2021, the NASDAQ hit its highs, and then there was a downward movement. And you can see the same thing with Bitcoin. Here we have 2021 as well, and you can see that there was a peak at first in 2021, then it dropped, and basically they look synchronized. But now the situation is different. During this period, Bitcoin and the NASDAQ looked similar, but on this rebound, the NASDAQ looks much stronger because this is no longer just a rebound, but a full-fledged bull market. They've already surpassed the previous high. And for us right now, it turns out Bitcoin is showing quite significant weakness. It can't even break above 80, and it's actually still pretty far from its all-time high. Our maximum was at 126, so to reach the high, it still needs to more than 50%. So at the moment, I always pay attention to situations like this when the market is showing weakness compared to other markets. And since the highest correlation is specifically with the US technology index at the moment, it turns out that Bitcoin, it shows that in principle, people aren't really eager to buy it. So like with everything else, it's happening, but weekly. What else should we pay attention to? Look, it turns out that Bitcoin option prices are actually at their lowest levels. And if you pay attention to my previous trade, I bought a corridor of $9,000 on Bitcoin, both up and down, 82 up, 73 down. So there's a difference of several thousand. I bought calls for 260 and puts for 190. If we, for example, look at the same thing now, for example, 82 calls accordingly for May 8th. Look, they cost, it turns out, Okay, let me just load the data. Here are the 82 calls on Bitcoin. You see, they cost $200. And it turns out, bought them back then for $260. At that time, Bitcoin was at 76, and now it's at 78,500. Yes, here it is, 78,500. At that time, I also bought the 73 puts for $190. Now, accordingly, the 73 puts. They cost $100, and accordingly, you can even take not the 73s, but a bit higher for about the same price. At the same price, or even cheaper, $155, $174. So it turns out the corridor is narrower, 82 to 74. At the moment, I can buy cheaper, and this is exactly what I was talking about. I mentioned that when there hasn't been any movement on Bitcoin weeklies for a long time, it starts to get cheaper. It's basically the same mechanism as when you don't get into any accidents while driving a car, your insurance starts to get cheaper. So for example, the first year of Osago costs a certain amount. The second year, if you haven't had any accidents, it's cheaper, and so on until you get into an accident. And it turns out that the market works in pretty much the same way. So if options are staying flat, or more precisely, if the market is staying flat, then options keep getting cheaper. For example, if last week we needed a move of about 7%, now if we take the range from 82 to 74, then accordingly, if we calculate it, we get 78,500. Multiply by 1.06, and you see even with a 6% move, our 82 option will already be triggered. If we go down by 6%, then we'll also end up below 74. Not that much actually, but still, the options will go in the money. So now it turns out that for the same money, as in last week we had a corridor of 9, and now the corridor is 8,000, and they cost less. So accordingly, I understand that even if, say, for another 3 or 4 weeks the market doesn't move, the options will become even cheaper. Because basically, if you look at the chart of implied volatility historically, overall, Bitcoin used to cost less. For example, in September 2025, volatility was about 20% lower. And accordingly, for example, in January 2026 as well. But in general, we are close to those levels now. So right now, it turns out that Bitcoin options are very cheap. So what is my forecast for next week? I expect that if the S&P starts to fall, and accordingly there is some bad news from the Middle East or any other negative news, there is a chance that Bitcoin might not break through 80 and could sharply drop down. Because it often happens that when the market is growing on good news and on the strength of another market, it can't really grow properly, and then some bad news comes along. It often drops sharply, and on the contrary, if, for example, it has been held down for a long time, and at that moment the sellers simply don't have enough strength, then a sharp breakout can occur. If you remember last week when I was analyzing open interest, I mentioned that we basically have 2 important levels for Bitcoin. So accordingly, it turns out that well, here, by the way, it's at May 80th, but our main open interest is actually concentrated not in May, but in June. So it turns out that 85 to 90 is to the upside. If there is growth, then most likely there will be quite strong resistance there, although in fact someone is also quietly selling at 80. And to the downside, it's only somewhere around 60. So as you can see, puts are not being actively sold yet. So if the green bars are quite high, well, that's actually logical, because often when people have a portfolio of Bitcoin or Ethereum, they sell a call option against it in order to increase their yield when the market isn't moving. But still, it's clear that hardly anyone is opening put positions closer to 60. In other words, the downside is much more open. So I expect that if there is growth, the market could easily break above 82 and reach at least 85 or even higher. That is into the area of the previous consolidation. If we still can't break through the 80 mark and head downward, then I think we could go down to 70. We could easily reach that level. And if there are really negative events, then I think we could drop to 65. So based on this, I will be focusing on the market breaking out of the 74 to 82 range. That is, my current range is already 8,000. If you remember last week, my range was 9,000. So accordingly, we've reviewed the range. As for volatility, basically nothing new. That is, over the week, our options have hardly changed. They've dropped a little more in price. In other words, they've become even cheaper. According to the Deltask chart at the moment, calls are still lagging a bit behind puts, but this lag is no longer critical. That is, if we take a week, but for example 6 months, you can see that the biggest lag behind the puts was at the end of February when the market was actively falling. Now, overall, this lag is practically unnoticeable. In fact, in a normal market, calls consistently lag a little behind puts. Why? Because when the market falls, it usually drops much faster, and that's why people are more afraid of a decline than of growth. That's why during an upswing, calls often aren't as expensive as, for example, puts are when the market is crashing down. So it turns out that volatility is cheap. The ratio of calls to puts is about the same, meaning overall, there isn't really a difference. There isn't any significant imbalance, and accordingly, the corridor, we've chosen it. So we end up with a corridor from 82 to 74. Next, let's go to our table. It turns out that at the moment, if we take 82 to 74, the movement is just 6%. And look, a 6% move happens every 11 weeks. So overall, these are fairly frequent events. In other words, such a movement happens every 1.5 to 2 months. And by the way, you could even take not 67. And note that in principle, a tail movement of 7% can also happen every 11 weeks. Starting from 8, even at 8%, it also occurs every 11 weeks. So basically, if the market now, for example, moves by 8%, then accordingly, the options position that I plan to open will increase by about 5 times. And overall, that means it covers roughly the previous 5 to 6 weeks. I'll easily be able to recoup that. And accordingly, for example, if we take a bit more, say 9 is actually still acceptable, by the way, 13 weeks, I think, starting from 10. Yes, notice how sharply it changes. So a 9% move can basically be caught almost every 2 months, but a 10% move is already harder to catch. For example, you might have to wait, it turns out, about 7 weeks. No, actually 28 weeks. That's about 7 months without a 10% move. So, considering that at the moment we only need a 6% move for our position to become profitable, let's now see what the backtester shows us. I've already copied the data for the backtest. Let's open it. And now we'll select a position. So, accordingly, it turns out I'm taking the 82 call option, adding it to the portfolio. By the way, before we proceed, we can take a look at the backtest chart. You can see that at current prices, the backtest chart is getting closer and closer to an almost perfectly upward curve. Yes, there are drawdowns, but visually they look very minor because the options are cheap. And even when it comes to put options, that is, for example, just out of curiosity, for example, the 76 put option. You see, there's a long drawdown here, and it turns out that even in a strong market, the options are still puts. At current prices, it's profitable to buy. If we look, for example, at the 74 put option, which I want to take, yes, I like the chart here a bit more. That is, if you remember, I usually look at the ratio of total return to maximum drawdown. And for the 74, it's one of the most optimal. Actually, just a bit lower, it gets even better, but then the win rate drops significantly. Win rate. So, for example, I could take the 73 with a more favorable ratio, but in that case, the win rate is already 8%, meaning less than 1 out of 10 trades works out. And here, accordingly, it's 11, so it's still a bit higher. And for example, you could even take some super cheap ones, 72 in case of a severe crisis, but then the win rate here is less than 1 out of 20 trades. Well, roughly 1 out of 20. So it turns out that here, the maximum streak, look, you could go 45 weeks without seeing such a trade, which is quite a lot. That's why basically 74 works for me. I'm quite satisfied with the options. So I add the 74 options to the portfolio, and for the 78, I use the old options pool and I run a backtest. By the way, notice that here the curve is almost a straight upward line at current prices, so overall in general, when I start to see a chart like this, I really want to start increasing the risk quite seriously. But I always keep the following in mind. For example, right now I have my risk. In the previous trade, it was 1.5%. So let's say we risk every week. If it's 1.5%, then our entire deposit would last for about, well, probably about 68 weeks. So we could withstand 68 weeks without any movement with a 1.5% risk. If you remember, as I just showed, the market doesn't stay flat for 6%, well, at most 11 weeks. So basically 60 is overkill. If we take a 2% risk, then basically that would last us for 50 weeks. By the way, it's also important to consider here that since we're dealing with compound interest overall, we'll never actually hit zero, we'll just gradually decline. So accordingly, a risk of up to 2% is actually very reasonable. In cases of super favorable opportunities, for example, when options become even cheaper, you can take a very narrow corridor. There you could probably even raise the risk to 3.5 or 4%, but 4 is already the limit. With a 4% risk, it really becomes a tough situation. After a series of losing trades, you might start to get very nervous. But right now, for example, I feel that it's quite reasonable to raise it up to 2%. So it turns out that... Let's take a look at the P&L. So if I open these options right now, the calls will cost me $235 and the puts will cost $140. Accordingly, the current risk comes out to $528. I believe that now it's quite reasonable to raise the weekly risk to about $1,800. That is, this is roughly 1.9% of the deposit. So accordingly, that would be about 3 options probably, maybe a little more. So actually, no, 3 options is even too few. At 1200, that would be 4. At the level of 1600, you could even consider going a bit higher, perhaps to 4.5. There you go. Yes, 4.5 is already perfectly fine, so the total risk involved here is exactly 1.9% of your initial deposit. Accordingly, if we look at a situation where, for example, the market moves by those same relatively small 7%, then calculating upwards, it would be a very different story. Somewhere around 84,000. So in this case, I would end up with a profit of about 7,000. So that's roughly a 1 to 3.5 ratio. If it experiences a significant decrease by about 7%, then in my professional opinion, I think it would be valued at approximately $73 or so. There, it would basically be more or less a 1-to-1 ratio. So for a risk of 1,800, I would earn about 2,400. But in reality, I expect that the movement should be at least a certain percentage. 10% if there's a spike in volatility. So that would be roughly a move to 86, and then it would be about 1 to 8, and the profit would be plus 16, or accordingly, if it goes down, somewhere to 70. Well, here it also comes out to about $16,000. So with this position, I plan to go into next week. Let me remind you that if during the week there are any sharp moves up or down, I plan to partially either lock in profits or adjust the position by selling slightly further out calls or slightly further out puts. I write about this in the description. If you want, you can subscribe to me. The link is below. So with this position, I'm going into this week, and that's the forecast I have. Friends, thank you for watching the video until the end. I would appreciate it if you support me with a subscription, a like, or a comment. And let me remind you that you can ask any questions about options in the comments to this video or accordingly on my platforms, which I mentioned again. The link is below in the description. And also remember that this video is not an individual investment recommendation. All trades you make are at your own risk. And it's not for nothing that I talk about the greater risks in almost every video. 4% per trade is my limit, and I don't recommend more. You can see I trade conservatively, currently reaching only 2% per transaction. Well, accordingly, let's see how this position turns out, and I'll see you in the next video on Sunday. Thank you for watching the video to the end. This was Roman Besedovsky with you. See you again on the Aptonomica channel. Bye.